Welcome to OA Accountancy Staff. In today's lesson, we will be looking at accounting books or books of account.
In our subsequent videos, we will be tackling the various financial accounting topics for WASI students and the financial reporting standards for the tertiary level. So, if you are new to this channel, kindly subscribe and hit the notification bell so that you'll be notified anytime we upload a new video. After going through this video, we should be able to know what accounting books are. Also, we should be able to state the broad classifications of accounting books. Again, we should be able to at least state two subdivisions of each of the broad classification of accounting books, and at least state one source document for recording in each of the subdivisions of accounting books. Okay, when you talk of accounting books, they are the books or documents that are used to prepare financial statements. Or accounting books are the books into which accounting transactions are recorded. So, after we knowing the definition of what accounting book is, let's proceed by looking at least some two important or reasons for keeping transactions in these accounting books. Reasons for keeping transactions in the accounting books. The first reason for keeping transactions in the accounting books is to know the performance of the organization. So we are saying performance of the organization. Why are you saying this? In the accounting cycle, which begins with the source document. After the source document, you analyze the transactions. After analysis of the transactions, you journalize or you record them in the various journals. So after you recording them in the various journals, then you post them to their ledgers. After the ledgers, then you extract a trial balance, and after the trial balance, you prepare a financial statement, and finally you interpret. So what you mean is that though the books of account does not give the performance of the organization, or the performance of the organization cannot be ascertained through only the books of account, but what we mean is that the books of account helps in the preparation of the financial statement into which performance or the profitability of the organization can be ascertained. So we are saying that the first reason for keeping transactions in the accounting books is to ascertain the performance of the organization. Secondly, we can also say that the second reason for keeping transactions in the accounting books is to meet regulatory requirements or regulatory compliance. Regulatory compliance. Here, what we mean is that in every state or country, there are rules or laws that compels every organization in the country or state to keep proper books. Here in Ghana, one of the rules or laws that compels organizations in Ghana to keep proper books is one, the Company Code 2019 Act 992. Also, another law that compels the institution here in Ghana to keep proper books. Organizations keep transactions in the books of account in order to meet these regulatory requirements. Another reason for keeping transactions in the books of account is for decision-making purposes. Decision-making purposes. So, after we knowing at least 3 reasons for keeping transactions in the books of account, let's proceed by looking at the classifications of these books of account and the subdivision of each. We are having the classification of books of account. Broadly, books of account are classified or grouped into two. That's the subsidiary and then the principal books. The subsidiary books are the books into which accounting transactions are first recorded. Due to this, it can also be called the books of first entry, because we are saying that they are the books into which accounting transactions are first recorded. So the subsidiary book can also be called the books of first entry. Also, these same subsidiary books, they are the books that keep the daily transactions of an organization. Due to this, these same subsidiary or books of first entry is also said to be called the day books, because they keep the daily transactions of an organization. It is also said to be called the journal because they keep or transactions are recorded in them in order of occurrence or chronologically. So due to this, the same subsidiary books or books of first entry or the day books is also said to be called the journals because transactions are recorded in them chronologically or in order of occurrence. Again, it can also be said to be called the books of prime entry. The books of prime entry or the books of original entry. Okay, so after we knowing what a subsidiary book is, let's proceed by looking at the principal books. The principal books, on the other hand, are also the books into which accounting transactions are recorded after journalizing. What we mean by journalizing is the art of recording transactions in the journal or the subsidiary books or the books of first entry, the day books, the books of prime entry, or the books of original entry. So after we recording transactions in the subsidiary or the journals, we then post them to the principal books. So we are saying that the principal books, on the other hand, are also books into which accounting transactions are recorded after journalizing. And these same principal books, another distinction between the principal and then the subsidiary books is the principal books complies or goes by the double entry principle. So after we know what subsidiary and principal books are, let's proceed by looking at the subdivision of each. So we will first be looking at the subdivision of the subsidiary books, and finally we will be looking at the subdivision of the principal books. So under the subsidiary books, basically they are grouped into 7. The subsidiary books are subdivided into 7, and they are the sales journal, or day books or sales book, the purchases journal, or purchases book or purchases day book. We have the sales returns journal, or sales returns book or sales return day book. The sales return journal can also be called the returns invoice journal or returns invoice day book. 4. We have the purchases returns journal or purchases return day book or purchases return book. It can also be called the returns outwards journal or returns outward day book. We have the column. We have the vertical, and finally we have our general journal. So we are saying that the subsidiary books or the books of first entry or the day books are subdivided into 7, and they are the sales journal, the purchases journal, the sales return journal, the purchases return journal, the cash book, the petty cash book, and then finally the general journal or the journal proper. Under the principal books, one school of thought classified the principal book or subdivided the principal book into two, and they are the Carl's book and then the ledgers. So we are saying ledgers and Carl's book. Another school of thought also consider the Carl's book to be part of the ledgers. So we will be going by the first school of thought, which classify or subdivide the principal books into two. That's the ledgers and then the Carl's book. So after we knowing the subdivision of both the subsidiary and then the principal books, let's take the subsidiary books. Then we will get to know the uses of each of these books and at least one source document for recording in each of them. We have our subsidiary books here. We said we'll be looking at the uses and at least one source document for recording here. Okay, we said the first subdivision of the subsidiary book is the sales. Now the purchases. Okay, so here are our subdivisions of the subsidiary books. Let's get to know the uses of each. But before then, let's try to define what these subdivisions are. So under the sales journal or the sales day book, it is a special book or it is a subsidiary book that is specially made to record credit sales. So under the uses, we are saying that the sales journal is a subsidiary book that's used to record only credit sales. So under the uses, we can say that it is used to record only credit sales. The purchases journal also is a subsidiary book that is used to record only credit purchases. So under its uses, we can say that it is used to record credit purchases only. The sales return journal, however, is also a subsidiary book that's used to record only returns of sales. The purchases returns is also a subsidiary book that's used to record returns of purchases. The cash book is a subsidiary book that's specially made to record all cash and bank transactions. All cash transactions, and when we say that all cash transactions, bank transactions are also included. Under the petty cash book, a petty cash book is a type of cash book that's kept by organizations with huge cash flow, that's both the inflow and then the outflow. The system for recording in this petty cash book is called the Impress system. It's called the Impress system. A system for recording in this petty cash book is called the Impress system. And what they do is that under the Impress system, initially, an amount or an initial amount will be given to a cashier who is called a petty cashier. Okay, so this initial amount is called the cash float. So initially, a cash float will be given to a petty cashier, and what this petty cashier will be using it for is to pay for petty cash expenses. So periodically, this petty cashier will be reimbursed. What we mean by reimbursement is he will be restored to the initial amount. So this petty cashier will be restored to the amount initially given, and he will use this amount to pay for all the cash petty expenses. Okay, so under the uses of this petty cash book, it is used to record petty cash expenses. So, in a situation where an organization is keeping both the petty cash book and then the cash book will not record all cash transactions, but rather it will record all cash transactions other than those contained in the petty cash book. This petty cash book, as we are saying, also has a debit and credit, the same as the cash book. So the initial amount that's given will be debited to this petty cash book, and then the expenses incurred or the expenses paid for will be credited under this petty cash book. We will be looking at a petty cash book or the calculation for petty cash book in our subsequent videos, so stay tuned. So after we knowing what this petty cash book is used to record, let's proceed by finally looking at the general journal or the journal proper. The journal proper, however, is also used to record any other transactions that does not find its way in the above listed journals. So under the general journal, it is said to record any other transactions. Okay, after we knowing the uses of each of these subsidiary rules, let's proceed by looking at least one source document for recording in them. So, under the sales journal, the source document for recording in the sales journal is the invoice. Under the purchases journal also, the invoice is also used. But to specify them, a sale invoice to a buyer is called a purchases invoice, and a sale invoice to a seller is called a sales invoice. So let's specify them by saying the source document for recording in the sales journal is the sales invoice, and that of the purchases journal is the purchases invoice. The source document for recording in the sales return journal, you can see the credit note. Why are we using the credit note? A sales return occurs when, after a customer purchases a product from you, he returns it due to some fault or other reason. So, when a customer purchases a product or a goods from you on credit, the customer becomes your debtor, and this debtor is having a debit balance. So when this debtor or this customer is returning the goods back to you due to some reasons, the customer will need to attach a credit note to inform you that the amount of indebtedness has been reduced. So that's why the sales document for recording in the sales return journal is the credit note. That of the purchases return journal is a debit note, because a purchases returns, however, occurs after you purchase a goods from your supplier on credit. So this supplier becomes your creditor, and this creditor is already having a credit balance. So when you are returning the goods to this supplier or this creditor due to some reasons, let's say due to faulty or some reasons, you need to attach a debit note, because the creditor or the supplier is already having a credit note or a credit balance already, So you need to attach a debit note to inform the supplier that the amount of indebtedness has been reduced. So the source document for recording in the purchases return journal is the debit note. That of the cash book is the receipt, bank statements, check counter for. There are plenty under the cash book. So you can see the receipts. can use the bank statement. That of the petty cash book can use the petty cash voucher. And that of the general journal can use the journal voucher. Okay, so after we knowing what the books of accounts are, the reasons for keeping transactions in these books of accounts, the subdivision of these books of account, the uses of each, and then the source documents, this will be the end of our part 1 of books of account. The part 2 will be uploaded soon, so kindly subscribe and hit the notification bell. Also, share for the benefit of others. Until we meet again, it's bye for now.